Time now for Options Corner. Joining us to take a deeper look at Shopify, we've got Rick Ducat, lead market technician. All right, Shopify shares up in the pre-market, but what trends are you seeing on the chart, Rick?
Well, it's been very sideways for the past quarter or so. And when we look at Shopify, this is one that seems to have some big moves on earnings on very heavy volume. I was struck by the large volume spikes. That's volume that's at least 50% above, in this case, the 50-day simple moving average there at the bottom of the screen. So you can see that typically these are heavily traded events. We had a nice gap up last time. But as I said, a sideways range between about 99 to 121 or so, 121 being the +1 standard deviation channel, and our old highs from that point, we could see the +2 channel come in at 140, Diane.
All right. Now, Rick, when it comes to options activity, did you find anything interesting in terms of how Shopify moved on Friday, for instance?
Well, sure. And I started out by looking at the open interest. I chose the monthly expiration series on February 21st this time. And, on the call side, most of the open interest is between about 110 to 130, other specific activity at 116, 140, and relatively far above at 175. The put side is much more widely dispersed. I couldn't even really give a general range because there's heavier activity as low as 70 and as high as 115. So kind of all over the map here. In terms of the most notable trade I saw, this one looked like it was a closing trade, minus 1,125 February 21st, 115 strike calls at about a 951 credit. This was a sweep trade. Looked like it was a closing trade, based on the volume. If that was true, theoretically, it would be like a $200,000 profit or so, Diane.
All right. That's some of the options activity that we saw with regard to Shopify. Shares getting higher in the pre-market. That was Rick Ducat, lead market technician. Now we've got an example trade for you to take us through that. We've got senior options contributor Tom White, also co-host of Fast Market. All right, Tom, how would you structure an example trade after this upgrade from benchmark?
Well, I think it's not only about the upgrade, it's about the stock sitting at about a 3-year highs, implied volatility levels, really elevated going into this report. The Ivy percentile rank about 78%. So we're in the top 3/4 of what we've seen as far as implied volatility levels over the last 52 weeks. So what does that do? That expands option premiums. So I'm pretty straightforward with this example trade here, where I'm going to sell something out of the money to the downside on the put side to take advantage of a neutral to bullish type stance here in Shopify going into these results. Option market's pricing in about a plus or minus 11% move in the shares. So pretty hefty move. As Rick mentioned, we see some pretty big moves post earnings. So going out to the February 14th weekly cycle. So just 4 days till expiration. These expire on Friday, really short-term positioning, where I'm going to sell that 113 strike put, and then I'm going to buy the 108 strike put. Short $5 wide, neutral to bullish. Put vertical, I'm collecting roughly, if the stock opens up right around 121 here, you're going to collect a credit of about $1.50 on that, right? So that's what you can make, $150 per spread, but it takes your break even all the way down to 111.50. That's about an 8% cushion to the downside, about 8.5% cushion to the downside before you start getting hurt on this one. Now, when we talk about higher implied volatility levels, selling out of the money verticals to take advantage of that high implied volatility, we've got about a 65% probability that that short 113 strike will be out of the money at expiration over the next 4 days. That's what you want. You want better probabilities of success. I mentioned got an 8.5% cushion to the downside before you get hurt. So this type of strategy, stock goes up, you profit, you get to keep that credit you collected, stock stays where it is, you keep the credit. Stock can even go lower, but remain above that 111.50 break even, and you can still be profitable on this type of trade. If you take a look at the move, anticipated market maker move, I mentioned about 11%. That's about $14. So we're in the realm of that one standard deviation move. So the idea here is you want some upside, you want it to kind of stay where it is, or you're comfortable with it going down, but you've got that nice cushion of about 8.5%. Before you start getting hurt on this type of trade, Diane.